Aight, homies. This is Cal and Henry's project. We're here to talk to you about monetary and fiscal policy, stuff like demand shocks, supply shocks, all that good and not so good stuff. And we're going to begin by going a little bit into fiscal policy, which is going to be in the next slide.
Fiscal policy is how Congress affects and attempts to regulate the economy to keep it at equilibrium. The main tools in the fiscal policy arsenal are government spending and taxes. Either one of these can be raised and lowered as policymakers see fit.
Here you see two graphs of the two different approaches to fiscal policy Congress can take. On the left, you got your expansionary policy, which is adopted by lowering taxes or increasing spending, and which is meant to decrease unemployment and increase consumer spending and GDP, because it ain't fun unless the homies got some. I did that wrong. We'll move on. Okay, so here we have graphed the contractionary policy that Congress can take, which they could affect by increasing taxes or lowering spending, and this is going to cut back on inflation and price level because, as you know, mo money equals mo problems.
Monetary policy describes how the Federal Reserve controls the supply of money flowing through the economy. Included is the ability to raise or lower the reserve requirement, how much money your banks are required to keep with them, buy and sell securities, and raise or lower the discount rate.
Alright, so here we have graphed the ways the Fed can alter monetary policy. First, on the left side, we have a reduction, which is caused either by the sale of securities, the raising of the reserve requirement, or the lowering of the discount rate. This is used to fight inflation directly by lowering the amount of money in circulation, though it also can result in increased unemployment. Alright, so here we have graphed an expansionary policy, and the Fed makes it rain here by lowering the reserve requirement, raising the discount rate, or buying securities. This policy increases the amount of money in circulation in the economy as a method of spreading around wealth and ending recessions, though it does result in increased inflation.
Fiscal and monetary policy can work together very well. When they have the same goal, the two policies can enhance each other, making them more effective. For example, expansionary fiscal and expansionary monetary policy will supercharge the economy and add a massive amount of energy into circulation. Of course, if the Fed and Congress aren't communicating well, they can have the opposite impact. Explanatory monetary and contractionary fiscal will do little but waste time and money in canceling each other out.
But of course, there's some problems that can't be solved perfectly with a nice, easy expansionary or contractionary policy. One of these being a supply shock! Ah! A supply shock is caused by a sudden reduction in the supply of a good and can send the country into a situation known as stagflation!
Stagflation happens when supply drops sharply. It shares the worst qualities of inflation and recession, high prices and high unemployment. Unlike the others, there's no easy solution to stagflation. Either expansionary or contractionary must be chosen, but choosing either will solve only half the problem while making the other half worse.
Of course, this can happen on the other end of the spectrum as well. A demand shock is a result of a sudden drop in consumer demand for goods, often caused by an interest rate rise or imbalance in the economy, which tends to catastrophically lower output and consumer spending. Alright, look, we both know we're gonna do it. Demand shock is a sudden surprise event that temporarily increases or decreases demand for goods or services. A positive demand shock increases demand, while a negative demand shock decreases demand. Both positive and negative demand shocks have an effect on the prices of goods and services. In economics, crowding out is a phenomenon that occurs when increased government involvement in a sector of the market economy substantially affects the remainder of the market, either on the supply or demand side of the market. One type frequently discussed is when expansionary fiscal policy reduces the investment spending by the private sector. The increased borrowing crowds out private investing. Originally, crowding out was related to an increase in interest rates from the borrowing, but that was broadened to multiple channels that might leave total output little change or smaller.
Savings and investment are affected primarily by the interest rate. For savings, interest rate is directly related and creates a positive slope between the two because an interest rates increase, saving becomes more lucrative, so people invest more. For investment, interest rate is directly related and creates a negative slope because the cost of a loan increases and interest rate increase.
The money market is a segment of the financial market in which financial instruments with high liquidity and very short maturities are traded, like what happens when you put a bunch of middle schoolers into a blender. The money market is used by participants as a means for borrowing and lending in the short term, from several days to just under a year.
Fiscal policy and the interest rate are inherently linked. The interest rate is the amount charged, expressed as a percentage of principal by a lender to a borrower for the use of assets. Interest rates are typically noted on the annual basis, known as the annual percentage rate.
Fiscal policy has a clear effect upon output, but there's a secondary, less readily apparent fiscal policy effect on the interest rate. Basically, expansionary fiscal policy pushes interest rates up, while contractionary fiscal policy pulls interest rates down.
To the ground!
The rationale behind this relationship is fairly straightforward. When output increases, the price level tends to increase as well. This relationship between the real output and the price level is implicit, much like the relationship between me and your mom.
Can we say that? Okay, yeah.
Maybe.
According to the theory of money demand, as the price level rises, people demand more money to purchase goods and services. Given that there is no change in the money supply, this increased demand for money leads to an increase in the interest rate. The opposite is the case with contractionary fiscal policy.
Alright, this is the end of our project. Big thanks to all the people who put up with it until now. That's surprising. I don't know why you're still watching.
Thank you, Commissar Rosenzweig.
Yeah, Henry's here too. Thanks, Mr. Rosenzweig, for accepting this as a project. Assuming you have, we don't know yet. Hugs, kisses, lots of love. I'm sorry for what I said about your mother. It's not true. She's a wonderful lady.